In December 2001, Argentinians walked into their banks and discovered something terrifying. The money in their accounts was still there. They just couldn't freely take it out. The government capped cash withdrawals at roughly 250 pesos a week, while restrictions were placed on transfers and foreign exchange. Within weeks, protests erupted, the president resigned, and Argentina defaulted on its debt. But Argentina wasn't the first country to discover this weapon, and it wasn't the last. Because when a financial system starts collapsing, governments have a choice: let everyone take their money out or stop them. And once you understand how that mechanism works, some of history's biggest financial crises suddenly look very different. There is a reason governments don't simply announce, "Your money is frozen." They use a sequence. First comes fear, then withdrawals, then emergency measures, then limits, then restrictions on moving money. And sometimes something even more serious happens. Deposits themselves can become part of the rescue plan. In this documentary, we'll follow that sequence, from Argentina to Cyprus to Iceland, and uncover the logic behind the Corralito Playbook. Because the uncomfortable truth is this: a bank account can say you have $50,000, but in a crisis, having $50,000 and being able to access $50,000 can become two very different things when everyone wants their money. A banking crisis rarely begins with a government announcing a freeze. It begins with people becoming nervous. One person withdraws money, then another, then thousands. And suddenly a bank has a problem. Because your bank doesn't keep every dollar you deposit sitting in a vault. It uses deposits as part of its funding base, supporting loans, investments, and other assets.
Most of the time, this works because people don't demand all their money at once. But confidence changes everything. Argentina discovered this in 2001. The country's economy was already under enormous pressure. The government was struggling with debt, the banking system was losing deposits, and confidence was deteriorating. Then came the run. During just 3 days at the end of November, private sector deposits fell by more than $3.6 billion, about 6% of the deposit base. That number mattered for one reason. The system couldn't afford to keep losing deposits at that speed. So, on December 1, the government introduced the Corralito. Cash withdrawals were capped at 250 pesos per week. Foreign exchange transactions were restricted, and the movement of money became increasingly controlled. The government wasn't trying to make people poorer overnight. It was trying to stop everyone from doing the same thing at once, getting their money out. And that distinction is the key to understanding the entire playbook. Because the first weapon isn't confiscation, it's liquidity control. The bank run trap. Picture a perfectly ordinary bank. You have $10,000 in your account. Your neighbor has $10,000. A million other customers have money there too. Everyone believes the bank is safe, so nobody panics. But imagine rumors spread that the bank might fail. You don't know whether the rumor is true. You only know that if it is true, being the last person in line could be disastrous. So you withdraw your $10,000. Your neighbor sees you. He does the same. Now another customer thinks, why are they withdrawing? And suddenly, fear becomes self-fulfilling. This is the brutal mathematics of a bank run. The more people withdraw, everyone else has an incentive to withdraw. And eventually, even a fundamentally healthy institution can face a liquidity crisis. That's why governments sometimes intervene before the banking system completely collapses. But here's the catch. Stopping withdrawals can stabilize a bank. It can also destroy public trust. Argentina experienced that contradiction firsthand. The restrictions were designed to prevent the banking system from being overwhelmed. Instead, they became a symbol of the crisis itself. Industrial production fell sharply in December. Construction collapsed. Protests spread. And on December 20, President Fernando de la Rúa resigned amid massive unrest. The lesson was devastating. A government can stop a bank run without stopping the economic panic behind it. And Argentina revealed something else. Freezing access to cash is only level 1. The playbook evolves. 12 years later,
the same basic problem appeared in a completely different place: Cyprus. In 2013, Cyprus had a banking system under extraordinary pressure. Deposits were leaving. Banks had enormous losses. And the country's financial system was so large relative to its economy that rescuing it threatened the government's own finances. The solution was extraordinary. Banks were closed temporarily. Then, when they reopened, withdrawals and transfers were restricted. Initially, individuals could withdraw only 300 euros per day. Transfers abroad were restricted. Payments by cards outside the country were limited. Even some term deposits were extended rather than immediately released. But Cyprus introduced something Argentina had made famous in a different form.
Your money could be restricted even if the bank itself reopened. That distinction matters, because a banking freeze doesn't necessarily mean the bank is closed. It can mean the bank is open, but your money cannot move freely. And Cyprus went even further. Some uninsured deposits at Bank of Cyprus were used in the bank's recapitalization. A preliminary assessment converted 37.5% of certain uninsured deposits into equity, while additional funds were temporarily frozen pending valuation. This created a completely different kind of fear. The question was no longer simply, can I withdraw my money? It became, how much of my money will ultimately remain mine? And that is where the Corralito Playbook reaches its most uncomfortable stage. The escape route gets closed. There is a problem with freezing withdrawals. People can try something else. If they can't take cash out, maybe they can transfer it abroad. If they can't transfer it abroad, maybe they can move it into another currency. If they can't do that, maybe they can move it to another bank. So governments facing extreme financial pressure may attack the escape routes, not just the ATM. This is called capital control. And Iceland provides one of the clearest examples. In 2008, Iceland's 3 largest banks collapsed within days. The country's currency plunged. The banking system was overwhelmed. And authorities imposed restrictions on capital movements to prevent a further drain of foreign currency and stabilize the financial system. Some assets held by non-residents in Icelandic krona were effectively blocked from being converted and transferred abroad. The goal was straightforward: stop capital flight. And here's the important twist. Capital controls aren't automatically evidence of a government trying to steal people's money. Sometimes they're used as emergency financial stabilization tools. The IMF itself described Iceland's controls as critical to avoiding a more severe economic collapse.